Silver's had a heck of a run.
Great to see you, my friend. And it really has. And I think, in reading a lot of the reports over the weekend, we did a blog at the beartrapsreport.com called You're Talking About a Very, Very High Frustration with Investors. And it's called the Cobra Effect. And what's happening, Brian, is on the planet Earth today, there's about $50 trillion of bonds that are now below 1.2%, 1.25%. So it's a convexity nightmare. And here's the most important point. It's not about inflation today, but the probability of deflation looking out 5 years has gone from extremely high to now low. So in other words, the deflation path of certainty, that deflation path that we've had through Brexit, trade wars, which was 5 years certain, is now 1 to 2 years certain. And if you're a bond investor, that's a big problem. You got to be long gold and silver and metals.
Okay, so two things. Number one, we've been waiting on inflation forever. I guess at some point maybe it will come, but big word alert. I know what nightmares are. I frequently have them. Convexity. When you say convexity nightmare, for those who are just getting a cup of coffee, what does that mean and why does it matter?
Well, think about it. You have when you don't allow the business cycle to function over longer and longer and longer and longer periods of time, you have more wealth on the planet. That wealth is in bonds. And now you have 110 trillion of bonds that are below 1.25. And that means, now remember, when you buy a bond, there's not a lot of upside and there's potentially lots of downside, as we saw in March, even with corporate bonds. So if you're in this environment and there's inflation and say, not now, there's not inflation now, but if you're in a bond that has a long-term cash flow path or a tech stock, and there's inflation in 2 years, you have to be long commodities now because there's so much money in that pool, 110 trillion, at risk to future inflation. It's not about inflation now, but it's about the convexity. In other words, the downside versus upside.
And so everybody's rushed into silver, to gold, even to platinum and palladium. How much more do you think they realistically might have to run, Larry?
Well, you think about just the money in the United States that's in big tech and bonds. So corporate bonds, treasuries, and big tech, you're talking $35 trillion. And the metals pool is small. Remember, here's a big thing. You've seen this, and you brilliantly pointed this out 10 minutes ago. The NASDAQ is buckling. Here's why. Companies like Netflix, their whole valuation is what's called terminal valuation. And what that means is they don't produce any earnings now. They're just plowing the money back into reinvestment, CapEx on content, right? So those companies are valued on a 10-year cash flow. So those cash flows in a deflationary environment, Brian, are extremely, extremely valuable. And that's why some of these companies can trade at 50, 60 times earnings. But if you go from certainty of deflation, to uncertainty of deflation, those valuations on tech can come down dramatically from 40, 50 times earnings to 20. And so some of these stocks are probably going to get cut in half in the next 4 to 6 weeks.
You really think cut in half? Well, I mean, let's hope not. We've been talking about this idea of market structure, the heavily, very heavy weighted, whatever. I was reading over the weekend how the notional value of options trading in some cases now exceeds the equity market on which it is supposed to be based. In other words, if you have a hamburger worth $1, we're trading options worth $1.25 on a hamburger worth $1. I mean, are you worried about this market structure concept, Larry?
Well, as you pointed out, the money is flying out of the cloud stocks, out of tech. It's going into, we're long Berkshire, we're long some of the banks, emerging markets, metals. You're just going to see this rotation out of, remember, stocks that are exposed to 10-year cash flow valuations, and there's inflation risk in 3 years, that money's going to flow into value in emerging markets.